Hey everybody, Jason Russell, branch manager, Caliber Home Loans. Hope you are having a terrific week and are looking forward to a 3-day weekend. Wanted to record a video. This is a presentation that I gave to a local group of realtors recently, and I just feel like it's a timely one that can, really speak to both potential home buyers and agents in our community. And the idea is what we call bulletproofing a buyer, right? And it's all about trying to increase the odds of getting a truly successful home purchase done. And there's a number of components that go into the idea of bulletproofing a buyer, right? It's both psychologically and strategically important to prepare. And as local lenders, it's important that we help bring vitamins, if you will, to our clients and to our business partners and their business, right? We want to help our buyers and our business partners getting bigger, stronger, faster, but also painkillers, right? We want to help the positive side, but we also want to help to mitigate some of the painful parts of potentially buying a home. And this idea of bulletproofing is more towards the painkiller strategy. We want to take some of the stress out of the home buying process. And there are 4 aspects to this strategy, though you may choose to implement not all of them, 1, 2, 4 of them, but we'll go through these in some separate videos just so you can get a feel for what we're talking about. So talking about kind of where we are here as a market, right? So look, we know it's frustrating. We know it's heartbreaking out there. And many times clients go out looking to buy a home and they give up out of frustration. And part of our job as counselors is to make sure that we have answers for our clients and to show results. And we can't follow the same routines in different markets than we're used to operating in, right? I should say we can't follow the same routines that we're used to in this different market that we're into. So what can we do to provide help to overcome the fear and the anxiety that our clients have and replace it with excitement, right? So let's kind of talk about that a little bit. And let's talk about where many clients that I talk to are, right? And many clients that I've talked to are feeling pushed, right? They're being pushed to move fast by lenders, realtors, everyone involved, and they're getting a little gun shy because of that. The idea of walking into a house and making an offer on it in less than 1 day is kind of scary, but honestly, that's the market in a lot of ways. So the key is to do that legwork up front. And there's a lot of areas where people feel uncertain. And the first of which is data. And I've heard from a ton of clients that, hey, it's 2007 all over again, right? My uncle said we're in a bubble, and they're relying on emotions to drive their decisions, not data. So part of our promise to you as a client is to show you data to come up with a plan to compete, which we're going to walk through, right? So the solution to all of this is to bulletproof your buyer. So the first of which is thinking about what our number one goal is as a lender, right? And that is giving that client the highest probability of getting an offer accepted. That's our goal, right? And the first thing is to understand why the market is doing what it's doing. And it's problematic because everyone feels almost manic right now, and people don't have agency over it. And the second thing I would say is that an average loan officer is going to tell a buyer what they can do, but an above average mortgage professional is going to show a client why they should do it, right? So we want to talk about the psychology of it. And then the third thing we want to talk about, there you go, is the appraisal gap strategy, right? So everyone's feeling it, although it's calmed down a little bit lately. And that is the purchase price is X, the home appraises at X minus 5%. And we need to overcome that, not just logistically, but we also need to set expectations to overcome it psychologically before it happens so we can manage the outcome. And then the fourth part that we'll talk about in this process is a fully underwritten approval. We want to write offers with where you don't necessarily have to have loan contingencies, because right now sometimes writing offers on a home with loan contingencies on them can be problematic. So we want to talk about what we as a lender can do to help compete with those cash offers and to provide sellers and listing agents an extra layer of comfort. So the first step we want to talk about is the comprehensive upfront market analysis. We need to be able to explain why the market is doing what it's doing and not just operating out of emotion. Okay. So the thing that I hear so much now is we're in a bubble. Well, let's look at the data and find out, right? So the biggest thing that we're running into right now, and the biggest reason why home prices are going where they're going, is that we have a massive supply problem in our country. And it's easy to see why. If you look at this chart that I put in here, this is a chart of how many new homes have been built by home builders. And if you look back, home builders back in the early 2000s were building upwards of 2 million plus houses a year. But after the Great Recession, right, builders were absolutely clobbered. And although we're slowly climbing our way back in, we have not gotten nearly out of that hole that we've been in. But we were climbing up, and then COVID hit, right? So COVID hit, you see, boom, everything dropped because everybody was stuck inside. And now we're starting to, see it come back a little bit. But it's hard to build affordable homes, right? Because of lumber costs, red tape with the government. There's a number of reasons. So the short answer as to why the market is going up the way it is, it's because of supply issues. And until builders are up to 1.5 to 2 million housing starts a year for 5 to 10 years, right? Because we have to make up for all this lost time of homes being built. Until we see that for 5 to 10 years, there's still going to be a short supply problem. Okay. If you look at this, which is the amount of housing starts created over time, this little white dot is the average amount of homes being built in a given year. Well, as you can see, 2003 to 2007, we had 4 consecutive years in a row of the record amount of homes being built at the same time. And that's because housing was in vogue in 2003 to 2007. That's why I got into the industry. So the feeling is the same because housing is in vogue now. And so the feeling is like it was 2006, 2007. But the underlying foundation of housing values are not nearly the same. Because again, look at the last 13 years. We have 13 straight years below the 50-year average of houses being built, right? So the supply problem is not even close to being addressed, and it's not even close to being what it was in 2003, 4, 5, 6, 7, right before the mortgage market blew up. Here is year-over-year change in housing inventory. And, for a long time, we hung around, right around 2 million homes for sale, except for that bubble period, right? 2003 through 2007. Since then, our homes for sale have been falling to the point where we're at the lowest level of inventory available since the National Association of Realtors started tracking it. So we are at the lowest amount of houses available, and yet demand is only going to continue, which we'll go through in a minute. Let's talk about the overall supply of homes available for sale, right? We're down 71% since 2007. As of about 2 months ago, we were at 1.07 million homes available. We have 330 million people in the United States, and we have 180 million households. Okay. So that means if we have 1 million homes for sale and we have 180 million households, that means we have one home for sale for every 18 families. So when someone says, oh, there was 20 offers on a house, shouldn't be that surprising. It's just demographics, right? If we look at year over year change in housing inventory, you can see California down 41% year over year, the United States down 52% year over year. Who sells their house in a pandemic? Very few people, unless you live in New York or Hawaii, apparently. So everyone else down massive amounts, right? Inventory is just not there. Talking about the amount of months of inventory available for sale, right? How many months worth of sales are available on the market? 2007 at the peak before everything blew up, we had 9.6 months of inventory per sale. 2021, 1.3 months of inventory. Okay. It feels like it's 2006, 2007 because there's a huge demand like there was then. But the difference is in 2006, 2007, if you wanted a home, there was 6.4 to 9.6 months of supply available for you to buy. We don't have that today. So this all speaks to supply problems, right? If we talk about Econ 101, supply, demand, what about demand? Well, let's talk about it. So here is a chart of the amount of births by generation, right? So if we go back here and we look at baby boomers for, about a decade, they had about a decade's worth of 4 million plus births in that generation. Gen X had a dip. Now, I'm not trying to get political here, but in 1973, Roe v. Wade passed. Okay, when you legalize abortion, you realistically are going to have fewer births, right? So the other thing to keep in mind is that the average age of a first-time home buyer is 33 years old. So 33 years after the passing of Roe v. Wade, that took us to 2006. Okay. So we had the lowest level of first-time home buyers in 2006, right? Because we had the fewest amount of 33-year-olds in a generation. But at the same time in 2006, we had a huge oversupply of homes, right? Because all the reasons we just talked about, home builders were building homes like crazy in 2006. So you had the fewest amount of people wanting to buy a home in 2006, 2007, but you had the most amount of homes available. So now if we fast forward to today, we look at millennial first-time home buyers that are 33 years old. Next year, there's going to be more 33-year-olds. The next year after that, there's going to be more 33-year-olds. The next year after that, there's going to be even more 33-year-olds. So again, we're in a situation with more and more demand as the years go forward with less homes available. So the data actually shows that demand is in the upcoming years is going to be higher, which means macroeconomically, values continuing to go up is a very likely occurrence. And when you think about being a first-time home buyer, I was one at one time. I deal with a lot of them, and I counsel a lot of them. And when first-time home buyers are nervous, it's because they're nervous about a bubble. But the data show that demand will continue. And unless home builders get their act together, inventory is actually going to be worse. So when people are nervous about a bubble, what they're really saying is they don't want to hear and they don't want to be the guy at the barbecue that bought a house in 2006 or 2007, right? And while there's no guarantee I can make that home values are going to continue to go up, all the data on the supply and demand aspect suggests that values will continue to rise. And when we talk about other aspects of potential demand, let's talk about what has changed from 2007. One of the things that caused the recession and how people to lose their home is, and anybody who was doing this back in 2005, 6, 7, like I was, if you could fog a mirror, you could get a loan. And after the Great Recession, this chart shows this is a chart showing the availability of credit, right? It was real easy. The chart was very high, very easy to get credit. And then boom, it was almost impossible to get credit. And it slowly started to improve. And then boom, COVID hit and it got hard again. And that's kind of where we're at, right? So it's much harder to get credit. It's only being out there to a certain group of people. And we do things like checking your income, checking your credit, make sure you have a job, things that didn't happen then, right? So let's talk about the idea of the risk of default based on where the current market is, right? So there's two things that could cause defaults, two major things that could cause a default, right? The risk of the borrower not paying and the risk of a risky loan product putting the borrower in a position where they can't pay, right? So we're talking about, many of you have heard of these loans, negative amortization loans, pick-a-pays, 2-year ARMs with 3-year prepayment penalties, interest only, all these kinds of things. These programs, for the most part, have all but disappeared, right? Everything now is a very vanilla thing. 30-year fixed, 15-year fixed, more money down, we qualify them to death. There's so much less borrower risk, as you can see by the color blue going away. And the fact that we've eliminated so many of those risky loan products means, from a risk of default and someone losing their home is so much lower today than it was back then. And what that basically means is the idea of, oh, well, everyone's going to lose their home to foreclosure. I'm going to wait till the next bubble because there's going to be another wave of foreclosures. The data doesn't support that. That's just a feeling, because we think that all housing markets have to, when they turn the other direction, it has to look like 2007. And there's nothing that suggests that, right? There's nothing that suggests there's going to be a ton of low-priced foreclosed homes on the market that's going to drag values down anywhere. And if you look at year-over-year home equity, right? The average home buyer in California, okay, year-over-year, from the start of the pandemic to April of 21, gained $55,000 in equity. And that's the other reason I've been saying that foreclosures aren't happening, because if you just got $55,000, let's say you lost your job because of COVID, well, the government's not letting banks foreclose. So you haven't had to make a payment in a year and a half. And let's say you come back and now you're way behind and you don't know how to get caught up. In 2007, that would have been a foreclosure. Well, I just got $55,000 in equity and I haven't had to make a payment in a year and a half. Why would I let that go to foreclosure, right? I'm not upside down. I can just sell the house and go rent, right? There's nothing here, guys, that points to home prices going down. Now, can we keep up with 13, 19% increases year over year? No. But even if that slows back to 5 to 6% appreciation year over year, like we're used to, that's absolutely sustainable. Okay. So when we talk about, are we in a bubble? It's really important that we just educate you, right? And you want your lender, if you're a buyer, a home buyer, you want your lender to talk about this. We want you to go in armed with the data that you need to make a good decision on potentially buying a home. And if you're a real estate agent, same vibe, right? We want to make sure that we're providing your clients that same kind of guidance so they can go out and they can make offers with conviction and understanding that, all else equal, the data is definitely on your side. So then the next thing that we really want to talk about when it comes to the idea of bulletproofing someone is the idea of addressing the psychology of a home buyer's situation. And how does a good loan officer educate someone, right? So I'm just going to kind of go through the process that I do with a new buyer who wants to sit down and go through this data. So a lot of clients are concerned about how much they're paying in rent versus a potential housing payment. But this is really a massive miss, right? Because not only are they worried about the market going up and up and up and up, but they're worried about paying more to buy a home versus what they are paying in rent. And how that will challenge them long term. So let's say, for example, someone is paying $2,500 a month in rent, okay? And you want to compare it to the new mortgage payment. That's going to be concerning at face value, right? But what we as local lenders can do is to take our clients through a process, right? So one of the things I'll do is like, Mr. Smith, if you decide not to buy a home today, which is a real possibility and one we want to account for, could you happily and comfortably live in your current rental for the next 5 years? And 95% of the time, a client says to me, no. And that's why they're talking to me in the first place. So my next question becomes, okay, so if you didn't buy a home, how much more would you be willing to pay for a different rental that has the things you want, right? Let's say they need another bedroom, another bathroom, they want a bigger backyard, whatever it is, right? And so a lot of times I hear something along the lines of, well, I'd be willing to pay, I don't know, maybe $500 more. And then I say, okay, how much is rent going to go up every year? And for whatever reason, the number seems to always be $100 a year. I don't know where that number comes from. So I just Google it, right? How much are rent prices going up in Vacaville? Very first thing, rent is going up 5% per year. So 5% on $3,000 is actually $150 a year. And then it's going to be a little more than that the following year and the following year and the following year. So in 5 years, your rent has gone from $3,000, right? It's gone from $3,000 to $3,750. And if you average it over 5 years, that means you're paying an average of $3,375 per year in rent. Now, many times what clients do is they compare the rent payments for where they're not going to live because they just told me they want to move. And you can't compare rent where you're not going to live to a potential mortgage payment, right? And most folks aren't just going to pull that thread all the way through. So it's really important that we educate. So how do we do that, right? We want to talk about the differences that aren't always obvious, okay? So let's take the next step. Let's say someone wants to buy a $550,000 house with taxes, insurance, and mortgage insurance. That payment's going to be, let's call it $3,200, okay? They're paying $2,500 a month right now. Is anyone excited about paying $700 more a month than they're paying right now? Of course not. So they'll tell their realtor, oh, I'm not sure it's the right time. Maybe I'll save more money. Maybe I'll rent for another year. There's nothing in my price range, all those things. They know they can buy at $550,000 because they have a piece of paper, a pre-approval letter that says they're pre-approved for that. They just don't know whether or not they should do it. They're already scared of the market, and then this $700 higher payment shows up. And this is why most lenders actually scare their clients with a pre-approval, okay? And that's why it's important that when you're dealing with this, you're dealing with a mortgage professional and, not just an average loan officer. So let's go through that. So the next thing we'll do is we're going to sit down with the client and we're going to discuss things that aren't obvious, okay? So it'll go along the lines of, Mr. Smith, if you pay $3,000 a month in rent, okay, to move into a new place like we discussed, not counting the increase of 5% per year, none of that money comes back to you, okay? You get no tax benefit. However, if you buy a house, in this particular client scenario, you would get approximately $191 per month in tax benefits. And then you would also get another $859 that's going to principal reduction, okay? This part right here is paying down your loan balance. That's like a forced savings account. So if you factor in the forced savings account, you're actually saving almost $900 a month by buying this home. Now, if you've ever asked someone what they pay in rent over the next 5 years, they never know. And the reason why is because it's terrifying. So let's go through that, right? Mr. Homeowner, over the next 5 years, you're going to pay $198,936 in rent over the next 5 years, and you're going to give that money to someone else. You get zero tax savings, zero equity. Alternatively, if you buy a home and we get the historical 5.48% increase of value in Solano County, that $550,000 house will then be worth $718,215 in 5 years. At the same time, you've paid the mortgage down in this window to $467,000. So in exchange for the $167 more you're paying on a mortgage compared to your hypothetical rental you're going to move into, for $167 a month, you have gained over $200,000 to your net worth. And this is after paying commissions to sell the home. Okay? And this is why getting pre-approved with a big push button get mortgage company or an online lender, those types of organizations can scare clients. And when you work with a local lender who really cares about this stuff and is passionate about educating our clients, they went from being afraid to buy a home due to the payment increase to meeting with a local lender and understanding that it would be financially irresponsible not to buy a home. And if that psychology isn't done when we're meeting with our clients, we're doing harm to them by allowing them to make emotional decisions that aren't in their best financial interests. So not only do we need to show them the data on the housing market to show that it's sustaining and it's growing, but we have to work within their own personal economy and make sure that they understand that. The next point that I'll make as far as bulletproofing someone as a buyer is the idea of the appraisal gap strategy. So everyone understands that in a market like this, you have challenges with appraisals. Okay, homes are selling for $650,000 and they're appraising for $585,000. Okay, two things need to happen when you're meeting with a client. Number one, setting expectations with that client that this may happen and that we are working through the numbers on how to overcome it. And number two, we need to be able to explain that strategy to the listing agent so that they accept our offer. Because we're going to have an appraisal contingency and they're going to want us not to have an appraisal contingency. And we need to be able to explain why that's okay, because we've already done the work. Okay. Even if it appraises for 10% below market value, and we can show how in a lot of cases they won't need to come up with any more money than they already did, and the buyer would still be approved. Okay. Then it's important for me as a mortgage professional to call that listing agent and when the offer goes in and to explain this strategy to them, right? We want our client to feel great. We want both realtors to feel great. We want the seller to feel great about accepting this offer. Okay. So let's talk about appraisals a little bit. We want to explain the difference between market value and comparable value. Okay. So when we want to ask why are appraisals coming in low, we want to explain those things. Okay. The speed that things are appreciating right now are just not leaving the appraisers much data to support a particular value. Okay. So that's where the solution comes in. All right. So let's talk about the psychology of it first though, right? Psychologically, we need to prepare our buyers for the scenario of an appraisal coming in short. We need to do it in advance. And that's why going over the economics of why a low appraisal shouldn't scare a buyer in advance is so powerful. Because if we don't go through this in advance, then folks start making emotional decisions. And we want them to make unemotional, logical decisions, right? So let's talk about it. How do we do this? Well, let's say in this scenario, someone goes in, says, I'm going to buy this house for $625,000. I'm going to put down 20%. Well, let's say it appraises super low at $585,000. Well, guess what? I can get you in at the same amount cash to close I promised, right? We went from 137.9, call it 138 to 138, even with a short appraisal, okay? I can keep your payment within $20 of the original appraisal. Okay. So we have this discussion about how let's say worst case, it comes in at 585. That's what the comps suggest. That's what the appraisal may come in at. Are you comfortable paying $20 extra if that happens? Yes, of course, right? I'm not going to walk away for $22 a month. Okay. And the way that we do that is we put a little less down. Instead of 20, we put down 14%. We pay the difference in the short appraisal. We buy out the mortgage insurance premium, and boom. And I'm not going to spend a lot of time on this slide because it can be paralysis by analysis, but you can press pause on this video and stare at it if you'd like. And I'm certainly happy to go through it in any example you'd want. But ultimately, what we're doing here in this scenario of a short appraisal is we're putting down $45,000 less money, and we're applying that $45,000 to the appraisal gap. And then we're buying out the mortgage insurance. Okay. The result ends up being the same amount of money out of pocket, and the payment's only $20 more a month. Now, sometimes clients may want to go another route, right? They may want to still put 20% down, but they'll put more from their own funds or get a gift from family or any of those things. But regardless of what the solution is, the important fact is that we are having the discussion in advance of the actual event. So we want to get through these potential short appraisals way up front so everyone knows and is going into, and they're not waiting on pins and needles for what that appraisal comes in at, because we have a strategy regardless. And then the last point that I'll make as it relates to potentially bulletproofing our buyer is the fact that pre-approval letters right now alone, they're not cutting it in a lot of cases. And a lot of times we recommend when I'm working with listing agents, I'll tell them, hey, don't be afraid to ask for your automated underwriting system findings, right? If you want to know really how truly qualified that client is, you may ask for those things. And I get asked for them all the time. But the problem with that strategy as a listing agent is that it's the bare minimum, right? It's only good. An automated underwriting system report is only as good as the information that was put into it. And that information is entered in there by a loan officer, not an underwriter. And the underwriter is the final arbiter of whether or not the money is getting loaned out. So wouldn't you want the underwriter to be the one to look at that? And that's why we talk about potentially going through the underwriting process up front, right? Getting it all the way through an underwriter, getting that blessing so there's absolutely no surprises. Now, before I'm going to offer this to a client, I need them to commit to some things up front, right? It costs us on the lending side about $750 to underwrite an approval up front. Okay. That's paying out bonuses and salaries, man hours, all those kinds of things. So I'm not doing this for every file to start with. So most loan officers have some level of requirements that they're going to ask for from a buyer before we do this. Okay. So let's talk about mine. I'm going to find out, are you actively making offers in the next 60 days? Are you ready to provide all the documentation that the underwriter is going to ask for today? And are we the right lending team for you and your family? And, I want that commitment that we're going to work together before, we spend all this time and man hours on something. So, and again, if nothing else, I'll have their income reviewed by underwriting, so you can at least trust that the automated underwriting findings are accurate in that sense. So don't be afraid to ask your lender if they do this kind of thing, right? At Caliber, we absolutely do this, and I have no problem doing it if we have a commitment to work together from the buyer. So in that scenario, hey, once we look at all four of those things, right? Talking about the market, we're talking about the psychology of being a buyer, we're talking about the appraisal gap strategy, and we're talking about underwriting in advance. With these strategies, we've essentially made this a cash buyer without the built-in discount that a seller gives to cash buyers, making our client's offer more attractive than that of a cash buyer. And we understand that, there is an emotional and a psychological aspect to the buying process, and we want to educate our clients as much as humanly possible. So I urge you to work with a lender that wants to go to this extent with their clients to, filter out a lot of the unserious buyers for our agent partners, and to make sure that our clients are feeling really, really good about the process. We want to answer as many of the what ifs up front, so that once we're in that 30, 21, 14-day close window, that everybody's feeling comfortable about where we're at, and where we're going. So hopefully you found these video series helpful. If there's anything that I can do for you in the future, any questions, if you want to go through this on your own individual scenario, I'd certainly be happy to. And again, Jason Russell, Caliber Home Loans. Hope you have a great day. Thanks.